Welcome to Talk Tickers, your deep dive into the world of earnings calls. Today, we're tearing into Frontdoor Inc.'s second quarter 2025 earnings report. And well, let me tell you, it delivered a really intriguing mix. Seriously strong operational performance, but coupled with a market reaction that honestly had us all doing a bit of a double take.
It's a fascinating one, isn't it? You see a company clearly hitting its stride, posting numbers that, frankly, shattered expectations.
Yeah.
And yet, the market's initial enthusiasm, well, it seemed to cool off significantly by the close of the day.
Right.
So our mission today is to, pull back the curtain a bit, decipher what's truly driving Frontdoor's success, and maybe try to understand that curious investor response.
Exactly. We're going to filter through all the details, pinpoint the strategic moves that really matter, and give you the full picture. So let's kick things off with the headline figures from Frontdoor's Q2. They didn't just meet expectations, they absolutely crushed them this quarter.
That's right. I mean, the numbers really do speak for themselves. Frontdoor reported non-GAAP adjusted diluted EPS of $1.63. That significantly outperformed the $1.44 consensus estimate.
Big beat there.
Huge beat. And on the top line, revenue climbed a robust 14% year over year to $617 million. Again, sailing past the $602.6 million consensus.
So right out of the gate, strong beats on both earnings and revenue. Impressive.
Yeah.
And it wasn't just about growing the top line, right? Profitability was a major highlight. They achieved a record gross margin of 58%.
58%? Wow.
Yeah. Now, that's a solid 130 basis point improvement from the prior year, meaning, their profitability per sale jumped by 1.3 percentage points. That signals some serious efficiency gains.
Absolutely. And look at adjusted EBITDA, a key measure of that operational profitability. It saw a really healthy 26% increase year over year, hitting $199 million.
Okay.
And net income grew 21% to $111 million. I mean, these aren't just like good numbers. They represent really substantial improvements.
They certainly do. And this strong performance wasn't just confined to the financials either, was it?
No, not at all. Their customer base grew too. Home warranty members increased by 7% year over year to 2.09 million.
Okay, so adding members.
Yeah, and it was even more telling, I think, from a financial health perspective, is their cash generation. Year-to-date free cash flow for the first 6 months, it surged an impressive 44% to $237 million.
44%. That's serious cash they can use for investments, acquisitions, or, returning to shareholders.
And they are.
And speaking of returning value, they're definitely putting that cash to work. Frontdoor repurchased $150 million worth of shares through July. This just paints a picture of a company in a very strong financial position, delivering on multiple fronts, and frankly, confident enough in its future to buy back its own stock. Now, these impressive numbers didn't just appear out of nowhere. What's the real engine behind Frontdoor's success this quarter? Let's peel back the layers a bit.
Well, what's truly fascinating here, I think, is how effectively Frontdoor is leveraging this sort of dual strategy. Smart acquisitions and robust organic growth, both fueling expansion.
Okay.
A prime example is that 210 Home Buyers Warranty, or HBW acquisition, closed back in December 2024. Management confirmed it's integrating ahead of schedule.
That's a huge win. They've actually raised their estimated cost synergies for fiscal year 25 from, $10 million initially, now up to $15 million.
$15 million, yeah. And they're projecting a run rate of over $30 million by 2028.
Wow. And for anyone listening, run rate basically means the annualized value of those savings once they're fully implemented.
Right. So this acquisition hasn't just boosted their volume, it's also strategically diversified their revenue streams. Especially with its new home structural warranty business, that contributed a significant $44 million to their other revenue this quarter.
$44 million just from that piece.
Yep. And if you connect this to the bigger picture, it really underscores the strategic foresight of that deal. It's not just about adding customers. It's about expanding into these complementary, potentially higher margin services and gaining efficiency through smart integration. It just strengthens their market position in a really meaningful way.
Okay, so that's the acquisition side. What about organic growth? You mentioned their direct-to-consumer, the DTC channel.
Yeah, that continues to be a real bright spot. We saw strong 9% organic home warranty growth in Q2.
9%.
And that marks 4 consecutive quarters of impressive organic expansion.
4 quarters straight. What's driving this consistent performance?
Well, they seem to have really honed their approach here. It sounds like it's driven by refined marketing campaigns, highly effective digital advertising, and also a targeted discounting strategy. specifically designed to fuel new member acquisition.
Right, the discounting. That does raise an interesting question, though, doesn't it? Balancing that growth push with profitability.
It does. Because while strategic discounting can definitely drive acquisition, maintaining strong margins, like that 58% gross margin, requires really effective cost management.
So how are they managing that balance?
It appears they are managing it well, particularly because they're also making this strategic shift towards higher return adjacent services. That helps offset maybe some margin pressure from DTC discounting.
Ah, okay. And speaking of adjacent services, this is where it gets really interesting, I think. It shows how they're thinking beyond just the traditional home warranty.
Absolutely. Frontdoor is successfully expanding far beyond their core business. Their other revenue category experienced a substantial 63% year-over-year increase.
63%.
Yeah, primarily fueled by their new HVAC program, some new Moen smart water offerings, and those 210 structural warranties we just mentioned.
Okay, tell me more about the new HVAC program. That sounds like a big one.
It really is a standout performer. Its full-year outlook has been raised for the second time now. They're projecting it to hit $120 million.
Wow.
That's almost 40% higher than last year.
Okay, what's making it work so well?
Well, a big part is new financing options. They're offering things like interest-free loans for 12 months. And that has led to a remarkable 75% increase in financing usage.
75% increase just from easier financing. Think about that for a second. When you're talking about big ticket items, often emergency items like an HVAC system.
Exactly.
Making financing easier clearly removes a major barrier for homeowners. It's a brilliant way to expand their service offering.
It really is. Plus, contractor participation more than doubled in 2023, and the quotes they're giving to members were up over 40% in the first half of the year.
Okay, that's huge momentum.
But here's the kicker, and this is what really caught my eye.
Yeah.
This program still has less than 2% penetration of their total membership.
Less than 2%. Wow. How significant is that upside from your perspective?
I mean, that's just a massive indicator of future potential. This diversification beyond core home warranties into these higher value essential services, it's a critical strategic move. It deepens customer relationships, significantly increases the average revenue per member, and ultimately contributes to a structurally higher margin profile for the entire business. That sub 2% penetration just means the runway for growth here is, well, truly immense.
Okay, so massive growth potential there. Beyond just growth, though, Frontdoor is also demonstrating some exceptional operational excellence and a real laser focus on customer experience, it seems.
Definitely. I mean, despite significant price increases and, ongoing macroeconomic challenges, their retention rate remained really strong at 78.3%. That's near an all-time high for them.
In this environment, keeping customers happy and retaining them at that rate, that is no small feat.
Absolutely not. And that strong retention, despite inflation and price hikes, seems to be attributed to a significantly improved member experience. A high percentage, 84% of jobs, are performed by their preferred contractors.
Okay, so quality control there.
Right, ensuring quality and consistency. That builds trust.
And they're leaning heavily into technology too, aren't they?
They are. The AHS app has seen growing adoption, now used by 14% of members. And apparently its video chat feature has proven incredibly popular for diagnosing issues quickly.
That makes sense. Saves time, maybe avoids a truck roll sometimes.
Could be. Plus, a strong 84% of members are on autopay. That streamlines operations, reduces churn, and likely boosts retention as well. Just makes it sticky.
Yeah, absolutely.
And what's also notable is Frontdoor's proactive embrace of artificial intelligence. They're not just dabbling. They seem to be really leveraging AI across marketing, sales, and operations.
Okay, how so?
Well, in marketing, it's enhancing campaign performance and audience targeting, making sure their messages reach the right people more effectively.
Right.
In sales, AI is apparently providing real-time coaching to their reps and streamlining lead qualification, making their whole sales process more efficient.
Okay, real-time coaching. Interesting. And operations.
On the operations side, AI is helping standardize member support calls, ensuring consistent service quality and improving authorization accuracy. That could speed up claims and improve customer satisfaction.
Makes sense. Management actually said they are already seeing positive results from these AI initiatives. That signals a really forward-thinking approach to efficiency and, competitive advantage. It's smart to see them investing here.
Absolutely. This continuous investment in technology and process improvement is just crucial for maintaining both margins and customer loyalty for what can be a very competitive and challenging service environment.
Okay. Now let's look at their updated financial guidance and capital allocation, because this really tells us about their confidence in the future, doesn't it?
It does. And Frontdoor has actually raised its fiscal year 2025 guidance for the second time this year.
Second time, wow.
Yeah. They now expect revenue to be between $2.055 billion and $2.075 billion. That's a $25 million increase from their prior outlook.
Okay, solid raise on the top line. What about margins?
Critically, their gross margin guidance was also lifted. Now 56%. It's a 100 basis point increase.
Okay.
And they're saying this reflects a more favorable macro environment than they maybe initially anticipated, along with the continued benefits of their internal process improvements and, of course, the integration of 210 HPW.
Right, the synergies kicking in.
Exactly. And adjusted EBITDA guidance was also raised, now expected between $530 million and $550 million. All very strong indicators.
And they're clearly committed to returning value to shareholders too, right? The share repurchase target.
Yes, that's been increased to approximately $250 million for the full year.
$250 million.
And this marks the fourth consecutive year of increasing repurchases. It just underscores their strong cash generation and a net leverage ratio that's trending comfortably towards 1.5 times.
That's a very strong signal of financial health and management's belief in the company's value, a clear vote of confidence.
It really is. However, it's worth noting one nuance here. Despite this overwhelmingly positive financial outlook, the full-year home warranty member count is still expected to decline slightly by 1.3%.
Oh, interesting. So despite the strong financials, member count down a bit.
Yeah, and this seems to indicate a strategic balance they're striking.
Yeah.
Maybe pulling back slightly on near-term discounting in the DTC channel.
Right.
While putting a very intentional focus on those high return adjacencies we discussed, like HVAC. It feels like a quality over quantity play in some areas.
Got it. That makes sense. And for the third quarter specifically?
For Q3 2025, the company expects revenue between $605 million and $615 million, and adjusted EBITDA between $180 million and $190 million.
Okay. So generally a very, very strong picture painted by the numbers and the management commentary. But this leads us to the interesting investor context and that enigma we touched on right at the top of the deep dive.
Indeed, because it's important to remember that the broader housing market is actually showing some, encouraging signs that could provide tailwinds for Frontdoor.
Right, the macro picture.
Exactly. Existing home sales, they actually tick up in July 2025 to a seasonally adjusted annual rate of 4.01 million. That's a 2% increase month over month.
Okay, a little positive movement there.
And what's particularly critical, I think, is inventory. The inventory of unsold existing homes rose 18% year over year in June, reaching 1.53 million homes, or about 4.7 months of supply.
Okay, 4.7 months. How does that compare?
Well, that's up significantly from just 3.5 months back in January. This hints at a potential transition toward more of a buyer's market.
And why is that good for Frontdoor?
Historically, a buyer's market has been quite beneficial for home warranty attach rates, meaning, more warranties get sold alongside home purchases when buyers maybe have a bit more leverage or caution.
Oh, okay. Interesting dynamic.
And remodeling spend is also expected to grow modestly through 2025, which should support their service and adjacent programs like HVAC. So the macro environment appears to be gradually, maybe slowly, turning in their favor, providing a helpful backdrop.
Okay. Now, here's where we circle back to the puzzle. The enigma. Despite this stellar financial performance, the second time raised guidance, an overtly optimistic management tone, the market's reaction was, peculiar is maybe putting it mildly.
Right. Initially, shares were indicated up over 11% in pre-market trading. That reflected some genuine enthusiasm from investors seeing those numbers.
11% up pre-market, you'd expect a strong open.
You would. Yet, the stock then closed down almost 4% on the very same day, and on significantly heavy volume.
Down 4% after being up 11% pre-market on heavy volume. Wow.
This divergence is quite striking, isn't it? It suggests that while the beat and raise narrative was undeniably clear and strong,
No question about that.
investors may have engaged in maybe profit-taking or some short-term repositioning, essentially selling off gains quickly, perhaps, rather than fundamentally rethinking the company's long-term value based on the report.
It really does raise an important question about short-term market dynamics versus underlying company strength. Why would such a strong report lead to a red close? Was it just, the market felt it had run too far too fast already? Or was there something else at play that maybe a long-term investor should consider?
It's baffling sometimes.
It almost feels like the market sometimes needs a reminder that the fundamentals still matter, doesn't it?
It absolutely highlights the often, let's say, less than rational nature of immediate market reactions, especially when a stock has seen significant run-ups before an earnings print.
Sure.
For those with a longer time horizon, though, these sorts of post-earnings dips, especially following fundamentally strong reports, can sometimes present compelling opportunities. If, and it's a big if, the underlying thesis remains strong.
Okay. This intriguing market anomaly really begs a crucial question for investors looking for opportunities, which brings us to our next segment. But before we dive into potential interpretations and trade ideas, just a quick but important reminder about the nature of our discussion here. Disclaimer. This segment is for informational and entertainment purposes only and should not be considered financial advice. Investing involves risk, and you should always do your own due diligence and consult with a qualified financial professional before making any investment decisions. Okay, with that said, given Frontdoor's robust Q2, that second consecutive raise in full-year guidance, and that frankly peculiar market close, here's a plausible, albeit maybe slightly contrarian trade idea for you to chew on and consider.
All right, lay it out for us. What's the thesis?
We're calling this one the undervalued growth long. The play here is pretty straightforward. A long position on Frontdoor, ticker FTDR. And it's based on the belief that the market overreacted to short-term profit-taking or maybe just noise and hasn't fully appreciated the embedded growth story here. The thesis is simple. The stock's dip on earnings, despite that clear beat and raise and an undeniably bullish management tone, presents potentially an attractive entry point for those looking beyond the immediate churn.
So you're basically positing that the market's immediate negative reaction was more of a liquidity event, rapid selling, maybe some algorithms kicking in, rather than a fundamental change in the long-term outlook.
Precisely. That's the angle.
Okay, so what are the key catalysts you see supporting this undervalued growth long idea?
Well, we see multiple powerful catalysts. First, that continued ahead-of-schedule integration of 210 homebuyers warranty, with those higher synergy captures now confirmed $15 million for FY25, heading towards $30 million plus by 2028. That's real, tangible value being created right there.
Right, the synergy upside.
Second, and perhaps even more significant longer term, is that massive runaway for the new HVAC program, currently boasting under 2% penetration of their total membership. That's potentially a multi-year growth engine that's really just starting to hum.
Okay, so integration benefits and HVAC growth. What about the broader environment? How does the housing market factor into this trade idea?
Well, as the housing market hopefully definitively transitions to a more balanced state with inventory improving, like we discussed, we believe the underlying business strength and those diversified revenue streams will drive a re-rating for FTDR.
A re-rating, meaning the market assigns a higher valuation multiple.
Exactly, reflecting its improved fundamentals and growth prospects. We anticipate this could push the stock back towards and potentially beyond current analyst price targets, which, by the way, are already up post-earnings. You see Truist at $71, Oppenheimer at $63.
Okay.
So we're looking at a potential, say, 15-20% upside target within the next 9-12 months. It's definitely a conviction long idea, but one we think is based on solid fundamentals versus maybe just transient market dynamics.
A bold call, certainly, but the rationale is clearly laid out there for consideration.
All right, so to recap today's deep dive, Frontdoor delivered an exceptionally strong second quarter, marked by robust financial performance, that successful and ahead-of-schedule integration of the 210 acquisition, and really impressive growth in new adjacent programs like new HVAC.
Yeah, and management's confidence just seems evident in that second-time raise of their full-year guidance for both revenue and adjusted EBITDA. Can't argue with that signal.
Absolutely. And while the immediate market reaction offered, a curious short-term anomaly, the underlying operational strength, the strategic diversification, and maybe some improving macroeconomic tailwinds truly position Frontdoor well for continued success, it seems.
They're clearly leveraging technology effectively, expanding their offerings beyond the core warranty, and driving efficiency across the board. It's a solid operational story.
So as you consider this deep dive, maybe reflect on how companies like Frontdoor are not just surviving, but actually thriving by adapting their business models to macro shifts and diversifying their revenue streams. It's a key theme we see again and again.
Right.
And perhaps, more importantly, ask yourself, is the market sometimes just too focused on the immediate noise, overlooking compelling long-term narratives that are unfolding right before our eyes?
It's a great question to ponder. And just one last time, remember, the insights shared today are purely for informational purposes only. They do not constitute financial advice.
That's right. We strongly encourage you to continue your own research, dig into the numbers yourself, and form your own informed opinions.
Always do your homework.
Thank you for tuning in to Talk Tickers. Join us next time for another in-depth look into the world of earnings.